There are a variety of investment accounts that we can use to hold assets. So I want to take a few minutes to describe the main differences and when each one might be appropriate. So broadly speaking, we can break these categories out into tax-deferred accounts, tax-free accounts, and taxable accounts. As part of the wealth expedition, I talk about two big goals. One is saving for retirement, and the other is saving for lifestyle improvement now, which can come in the form of either starting a business or creating a personal discretionary fund for yourself to draw from. Let's start with retirement. For retirement, it makes sense to use accounts with tax benefits, such as tax deferred or tax free. Now, I think a simple illustration might best help set the stage for how to think about these two types of accounts. Imagine someone has $10,000 that they invest in year one. We'll call this person Jim. Jim's effective tax rate, which means his actual taxes paid as a percentage of his gross income, is 15%. We're just going to make that assumption. He has the choice of whether to invest this using a tax-deferred account or a tax-free account. Now, certain accounts like IRAs have annual limits, and they're currently below $10,000. So let's assume we use employer-sponsored retirement accounts like a 401k in this illustration so that we can get the full $10,000 into the account in year one. If he uses the tax-deferred account, that means he can write this $10,000 off of his taxes and will not be taxed on it this year. How does this benefit him? Well, the taxes he saves on the $10,000 means that the money he has to spend on everything else is not exactly $10,000 less than it would have been. Let's say that another way. Let's say he saves 15% on $10,000, meaning he is actually only out of pocket $8,500 for this savings because he's received a tax benefit of $1,500. Another way to say this is if you were putting $10,000 into the account over 12 months, that would amount to $833.33 per month. But because he's receiving the tax benefit, he doesn't have to withhold as much tax on his paycheck. So he's actually receiving an extra $125 a month that's not being withheld in taxes. So net out of pocket, he's cutting out $708.33 per month to save $10,000 into his tax-deferred retirement account that year. With the tax-deferred account, he's delaying the payment of taxes until he takes it out. So examples of tax-deferred retirement accounts are 401k, 403b, 457b, and IRA. What about the tax-free account? Think of these as Roth accounts, Roth 401k, Roth 403b, Roth IRA, etc. Using one of these, Jim will not receive any tax benefits this year for the $10,000 he's saving. He's going to have $10,000 less to spend this year because he's saving into a tax-free account. So with the tax-free account, he's still paying what would have been paid on his earned income. But when it comes time to withdraw in retirement, he will get all withdrawals tax-free. So how does he choose between these two? If cash flow is very tight, then he may be better off to use the tax-deferred account. This puts some money back in his pocket now due to lowering his tax bill in this year. If he expects to have a lower effective tax rate in retirement, then he may be better off to use the tax-deferred account and save taxes now. This could either be the result of tax regime changes, or it could be the result of simply planning to have a lower income in retirement. Alternatively, he might use the tax-free account if he has plenty of cash flow and isn't living paycheck to paycheck. He can afford to pay the tax now without risking having to go into debt because of an emergency. If he expects to have a higher effective tax rate in retirement, then he may be better to use the tax-free account and pay taxes now while he's in the lower bracket. If he already has a very large tax-deferred account saved, then he wants to be aware of how this could potentially push him into a higher tax bracket in retirement due to what's called required minimum distributions. We won't get into that here, but it's another thing to think about. If he wants flexibility to withdraw the principal contributions penalty-free prior to age 59 and a half, then that's allowed within a Roth IRA, so something else to consider. The first question than is about cash flow. That's pretty straightforward. But the guess as to whether he will be paying a higher, lower, or similar effective tax rate in retirement is not so easy to quantify. It requires a good deal of assumptions and projections to make any sort of an educated guess. For some, this might be more obvious an answer than for others, but in the end, one account is not inherently better than another. Because here's how it plays out if all things remain the same regarding Jim's effective tax rate. Let's say Jim is paying 15% effective tax right now, and in retirement, he will also be paying 15%. With a tax-deferred account, he could save $10,000 in year one and let it grow for, let's say, 20 years. We'll use an average annual growth rate of 8%. That $10,000 would be worth about $46,609 in year 20 under these assumptions. But if he gradually withdrew that $10,000 while paying 15% tax, because it's tax deferred, he technically only has access to $39,618 after tax. With the tax-free account, let's say he does the same thing, but instead he pays an extra $1,500 in taxes this year because he doesn't get the benefit of saving into a tax-deferred account. Of course, using the same assumptions, that $10,000 saved in year one would be worth $46,609 by year 20, assuming that 8% annual growth rate applies. So wait a minute, the tax-free account has $46,609, and the tax-deferred account only has $39,618 available after an assumed 15% tax rate. So how is the tax-free account not better? Well, because remember that Jim saved $1,500 in year one using the tax-deferred account, and technically he could have spent that $1,500 any way he wished. But what he could have done is take those extra savings of $1,500 in year one and invest them in a tax-free account. If he had invested that $1,500 tax savings in a tax-free account that year, alongside his $10,000 in the tax-deferred account, his two accounts would have come to $46,609 in the tax-deferred account and $6,991 in his tax-free account. This makes the two scenarios more equal because he's left with net zero extra cash in both scenarios now, rather than running away free with an extra $1,500 in the example of the tax-deferred savings. So if Jim has $46,609 in his tax-deferred account, and we take 15% from this to get a net $39,618, then add that number to the tax-free amount of $6,991, and we arrive at $46,609. And so both strategies, whether using tax-deferred or tax-free, arrive at the exact same net number if we assume that all available capital is employed in year one. In summary, there's no one-size-fits-all, but it comes down to individual situations that have to consider cash flow, emergency fund, and expectations of future tax rates and earnings. So as you think through which account type might be right for you, just remember to consider those factors. And also remember that retirement accounts can be accessed without penalty at age 59 and a half at the earliest. Now, there are some exceptions for Roth accounts. The principal that's added to a Roth account, particularly like a Roth IRA, can be withdrawn without penalty prior to that age 59 and a half. But any growth within a Roth account, as well as any of the traditional retirement accounts, will come with a 10% penalty on top of any taxes owed. So anything going to retirement is really meant to be there until at least age 59 and a half. And any shorter term goals pre-retirement age would be funded using taxable accounts.